Alright, what is up guys? Welcome back to another video. Today's video we are going to be talking about why you guys should not wait to invest. Now, it doesn't really matter the circumstances. We're going to cover everything in today's video. Now, the three major reasons why I say you guys should not wait to invest is number one, time is your best friend. The longer you're in the markets, the better chance you guys have of getting the outcome that you guys desire. If you wait till you're 25, 30, 35, you're putting yourself in a worse and worse position. Number two is the things that you guys are going to learn by being in the market. Doesn't matter how much money, doesn't matter if it's $5, $10. Being in the market is going to help you guys learn lessons, make those mistakes, and then you guys can learn from those and utilize them as you guys get older and have more and more money. And then obviously the more time that you guys are in the market in general, the more things you're going to pick up, the more pattern recognition you guys are going to have, and you're going to be able to take advantage of opportunities better down the road. So those are the three things we're going to talk to. I'm going to get into them all in detail. So with that said, let's get right to it. Like I said, the number one reason why you guys do not want to wait to invest is because time is your best friend. I don't know who said it exactly, but they said the eighth wonder of the world is compound interest, and that is absolutely true. If you guys have never seen or used a compound interest calculator to figure out how much money you have and the power of just investing early, I'm going to show you guys that right now. So what I'm going to do is I'm going to do a screen recording. Boom, so we're going. So let's say that you guys are 20 years old and you want to invest. So let's say you invest, or let's say you're 30 years old, right? So you waited to invest. You invest $1,000 initially, or let's say 5,000, right? And then every single month, let's say you add 500, right? And then let's say over the course of 30, let's just say 30 years till we're 60, okay? So boom, that'll take you to 60. Let's say your average rate that you guys get is 7% per year. And then let's say, yeah, boom. And then it compounds annually, right? So let's calculate it. Boom. So at 30 years, you'll have $600,000. So that's if you guys waited until you were 30 years old to make a $5,000 investment, and then every month adding $500 to that investment portfolio and compounding at 7%. Now, let's say you guys do the exact same thing, but you start when you're 18. Now, obviously, it might be tough to invest $5,000 and $500 a month, but let's say you guys didn't go to college, right? You take the money that maybe you would have spent on college and you invest that into the stock market. Boom, you put $5,000 in, and then $500 every single month. So to get to 60 years old, it would be what, 42 years, right? So this one was $600,000 for the person who waited until they're 30. Let's say the person who does it when they're 18. Let's see the difference. Boom, 1.5 million, almost a whole $1 million more. Now, a lot of different things go into this, but again, this is kind of just a very small example that you guys can take and just, wow, like the longer I'm in the market, the more money I can have. Even if you guys, let's say, start with $1,000, and even if you just invested $100 a month for 42 years to take you to your 60 at 7% return, which is very average, you're still gonna have 300 grand, right? For only $100 a month. As you guys get older, as you make more money, you'll start investing more money, yada yada yada, right? You get the point. But again, that's just to kind of show you guys how powerful compound interest is and the effects of just starting early. Now, that's obviously one of them, is you're going to benefit off compound interest. The other one is you're bound to make mistakes. So let's say you guys invest, you see it go down 10-20% like it is right now in the stock market, right? The S&P is down 21% year to date. So say you guys invest at the beginning of the year, you know what, I'm going to invest $1,000, boom, you see it go down 20%. Your first initial reaction might be, oh, I'm going to sell it, whatever. Maybe you invest in this company, it doesn't work out, you sell it. Maybe this company's not doing anything, so you sell it, then it goes up, right? You're learning a lot of these lessons, and the earlier you guys can make those lessons and learn those mistakes, the better. Because again, if you guys wait to invest, say you wait to invest till you're 30 and you're making $200K a year, right? You're making a lot of money, but you waited to invest, you're not going to have learned those lessons. So now when you learn those lessons, it's going to be with a lot more money. It's going to be a lot more serious, say because you have wife and kids, right? So now you're learning these lessons when it really counts and when you can't afford to lose that money. So maybe you have to play it extra safe in the market, and that's going to kind of hinder your returns in the long term. So that's kind of point number two, is just get those mistakes out early, right? If you guys can invest when you're 18, 19, make those mistakes and then learn from them, and then make sure you don't make those mistakes as you guys go. That's when you're going to really benefit from investing at a young age, right? So I would highly recommend, as soon as you guys turn 18, start investing. Now, next point kind of on top of that, is it does not matter the amount, right? Because like I said, those mistakes whether you make them with $10 or $100,000 are the same mistakes. And granted, if you can only afford to invest $10, I'm sure it's going to hurt the same as the person who's leisurely throwing 100 grand into the stock market, right? So it doesn't matter if it's $10. You're building that habit, right? That habit of monthly contributing $100 every single month, no matter what. Even if it's $10, it's the same thing. It's the habit. If you're not investing when you have only say $1,000, because I don't have the money, then you're not going to do it when you have 10,000, because you're going to increase your expenditures. You're going to say that you need other things, and you're going to say, oh, I can't afford it right now. And then you're going to keep waiting and waiting and waiting. And again, you're not going to be able to utilize compound interest. You're not going to learn these mistakes, and you're not going to learn, and you're not going to see these patterns that we're going to talk about next. So that's kind of my third point is the longer you're in the market, the longer you start to pick up patterns, right? It's that pattern recognition. Okay, interest rates go up. This kind of happens. This kind of news comes out. Boom, this happens. This time of year, stock market tends to go down. Boom, I see a 5% retracement. Typically going to see it go up. So you start to pick up on these patterns, and you also start to learn about different sectors, right? So whatever your area of expertise is, say you guys are in tech, okay, boom, your area of expertise might be there. So you're really in the stock market looking, boom, seeing how these things are moving on a daily basis, and you're starting to pick up these patterns. Okay, boom, I want to really invest in that one. Or you start to really learn about these companies and the benefits to them and where the government wants to spend their money. Okay, boom, I'm going to get in this. And then all of a sudden you see a 25% increase in, say, 6 months, right? Because you saw these patterns, you saw everything brewing, and you picked it up because you were in the market for so long, because you were looking at things on a daily basis, you were able to take advantage of that. So that's another extremely key. Again, it doesn't matter if you only got $10 in there. If you have $10 in the market, if you have $10 in crypto, whatever, you're going to see it move. You're going to learn your lessons. You're going to pick up on patterns, and you're going to be able to take advantage of it. So the last thing that you guys should be doing is saying that you guys do not have the money to invest. If you guys can spare $10, you guys have the money, and you guys should start to get in, because if this is something you guys want to do more long term, this is extremely important. Now, if you're just a very passive investor, whatever, you don't want to look at the markets, you don't care about selling, you just literally just want to throw it into the S&P 500, that's completely fine too. Again, you shouldn't wait to invest in that case either. But especially if you guys want to be a little more active or really heavy into the investments, then this is something you guys need to do immediately, and you guys should not wait, because the longer you wait, the worse it's going to get. Again, you're going to learn those lessons the hard way at one point or another, so it's better to learn it with $100 than 100,000, right? So that's kind of today's video. This is something that I try to tell every younger kid. This is something that I wish I could tell my 16-year-old self to start to get into this stuff. But I did kind of start to invest when I was 18, but I didn't really get into it till I was, say, 2021. COVID was really when I started to dive into it. So yeah, don't wait. Get started. Get in the market.